U.S. equities just had their worst day in more than 18 months, and the two worst performing stocks in the S&P 500 were Lamb Weston and Tesla, both on disappointing earnings, and we're going to talk about that today on Open Interest. Hello everybody and welcome. I'm Mike Coe. Welcome to Open Mic. So the S&P fell over 2% today. The two worst performing stocks, as I just mentioned, were Lamb Weston and Tesla. Two very different businesses, but two very similar results following disappointing earnings. And one of these two companies, I think, may actually now represent an interesting juncture at which one might consider taking a long position. And that company is Lamb Weston. So let's just talk a little bit about Lamb Weston because it's not a mega cap company. We tend to talk about mega cap companies, or at least large cap companies. This was a large cap company not that long ago, but it has fallen below $10 billion market capitalization, although the total value of the business when you include debt is just about $12 billion. So let me just read a little bit about the company, and this is from their own description of their activities. Lamb Weston is a leading supplier of frozen potato, sweet potato, appetizer, and vegetable products to restaurants and retailers around the world. For more than 70 years, Lamb Weston has led the frozen potato industry in innovation, introducing inventive products for our customers. Lamb Weston products can be found in more than 100 countries around the world. The business is headquartered in Eagle, Idaho, with manufacturing operations focused in the Pacific Northwest, primarily in the world's best potato growing region, the Columbia River Basin. Lamb Weston employs more than 10,000 people around the world in sales offices, manufacturing plants, and corporate offices. Okay, so obviously the street was quite disappointed by their earnings results. And what was interesting to me, two things actually caught my eye. One of them was that I tend to rely on Bloomberg as the source of a lot of my data. And I'm just going to very quickly bring up a Bloomberg screen so we can take a look at, and this is just high level, so there's a couple different screens here. We could look at income statements, balance sheet, cash flow statements, and so on. The view that I'm bringing up on my Bloomberg right now is basically a summary screen. So it's the FA function in Bloomberg. It's just basically a high-level sort of highlight view of the financials. So you're going to have things like revenue and gross profit, EBITDA, EPS, and things like that. What is interesting to me is that information tends to flow through to these systems pretty quickly. But if you take a look at this and you're taking a look at their fiscal year 2025 earnings estimates, we can see that the adjusted EPS estimate for fiscal year 2025, which is basically their fiscal year ends at the end of May, $6 or just over in earnings per share. And that differs quite considerably from what the company is now forecasting. So what we are now seeing, and this is their actual press release, you may not be able to read it, but I'm going to read it for you if you can't. So let's just go over some of the highlights. So GAAP results compared to the fourth quarter a year ago. Sales decline of 5% to $1.6 billion. Income from operations improved 14% to $213 million. But net income declined 74% to $130 million. Diluted EPS was just 89 cents a share. And of course, disappointing trailing results. So what just happened can hit a stock, but what really is going to impact people's perception of what the company is worth is the outlook, the forecast. And this is where things get interesting, because if you remember from what I just showed, essentially the consensus view was for about $6.07 a share. Right now, the company is guiding for fiscal 2025 net income of $630 to $705 million bucks. That works out to fully diluted earnings per share of between $4.35 and $4.85 per share, considerably below the street's view of 607. But what I would like to point out, and that I think is kind of interesting, and of course, whenever you have a situation where they miss and guide lower, we got both, not a good thing, right? Let's not sugarcoat this. And if we take a look at the chart, one of the things we can also see, this is a 5-year chart, but actually let me just take it back for 1 year, because this is the second consecutive earnings disappointment that they've experienced. We can see this is the gap lower here. If we go back to the last quarter, we had similarly another gap lower. Okay, let's assume for the sake of argument that let's take the lower end of that guidance, $4.35. All right, so the company's trading 56 bucks right now. And that puts it at about 13 times, in round numbers, the lower end of that range. That seems pretty cheap. Is it cheap? Well, let's take a look at what the company's metrics are on a longer term basis. So I'm going to get rid of this earnings thing. So one of the things you're going to notice is that there was a big, let's just get rid of this so we can just take a look at the revenue picture. And I'm going to highlight this because it's probably a little bit hard to see. All right, so this is the 5-year revenue picture for Lamb Weston. And one of the things that we can see is that the EPS sort of tracked that quite closely, probably too closely. So essentially, it looks as if revenues increased probably on higher prices, and a lot of that flowed through to the bottom line. And we can probably confirm that a little bit by taking a look at how margins have done. And even if we go back to say longer term lower margins, so we can go back to 2022, we can see that they had 2021. We're looking at somewhere between 6 and 10% margins. So in recent years we had meaningfully higher margins, probably able up into that 13.7 level, which is what they got for fiscal year 2023. Even if we revert back to the mean, so that's essentially getting us to those numbers that they were talking about. The top line growth picture doesn't have to be that phenomenal. It's still growing at better than GDP. They're kind of in a staples business. I think the potato business is a pretty straightforward business. They're selling French fries effectively. 13 times a much, much lower number. A number that essentially gets us down to that narrower end of their margins historically. We talked about this on the stream on Monday and some other times as well when I have talked about margins of safety. A margin of safety comes from a lower valuation, and hopefully a lower valuation off a low-end estimate, right? So you are taking a conservative estimate on what margins will be, a conservative estimate on what EPS will be, and a conservative turn of those numbers. And I think we're getting to that point right now with this business. So if we take a look, what are ways that we can kind of think about this? Well, looking at this earnings per share, I don't want to look at that for a second. I would rather, for now, like to think about this on a price to sales basis. So let's just take a look at price to sales over a long term for this company and see how things look. So what do we have? This is the price to sales number 10 years. We're at the lowest that number has been in 10 years. And this right here represents how revenues have been going. So I would suggest that the news could worsen even from here, and the valuation is not that bad. Now, a couple quick points I want to make about this. Generally speaking, it's not the best idea to race out and try to catch the falling knife after you get a disappointing number like this. Usually in the ensuing couple of days, trading days, you're going to get an opportunity to see what real money accounts might be doing. Are they, because they can't pivot on a dime. If you are an institutional holder, and we can take a look at who the institutional holders are and what institutional holders have been doing of late, and we'll just take a look at some of the bigger sellers recently and see what they have left. So bigger sellers, So most of these, as you can see, have been hedge funds, right? So, and of course, the Duquesne family office, so that's Stanley Druckenmiller. Then we've got, Viking, Citadel, Artemis, 0.72. So that's all hedge fund sellers. And if we take a look at the larger buyers, actually we've got a couple hedge funds in there as well. But, government pension funds, JP Morgan, Jane Street's just a market maker, so I don't necessarily, one of the preeminent market makers and high frequency traders. I'm not meaning to be dismissive about it. What I am trying to say, though, is that they're probably not taking big directional views on the stock here. So it is possible that there could be some follow-on selling coming out of this. But at the same time that the stock price has declined precipitously now after 2 disappointments, and we're now getting to a price to sales that is the lowest that it has been in 10 years, and even if we think that sales flatline, and even if we take the lowest end of their range, the $4.35 in EPS, this seems to me to be getting to a level where it might be worth dipping one's toe in the water. Now, of course, implied volatility, that is the price of options, has gone up as a result of this. Now, if we're looking at this chart, the orange is the realized volatility. This isn't necessarily representative because you can see this huge spike here. That's simply a function of today's price jump, the gap lower. The white line, so I'm going to get rid of that for a moment. The white line, by contrast, represents the implied volatility of 3-month options. And the 3-month options would necessarily include the subsequent earnings, which right now are expected to take place October 4th. So let's just say, for the sake of argument, that you are willing to be net short options at an elevated premium, favoring the long side. This is one of those situations where maybe a call spread risk reversal might make sense. We'll see how this one shapes up. I'm just going to pull up OptionPlay real quick here, because when I was looking at this earlier today, one could put this on actually for a credit. So let's just see where this ended up closing, because I was looking at this before the close. But I was looking out to September regular way, no weeklies here. Not that it would matter anyway, because you're going to go out a couple of months anyhow. So let's just take a look. And you can see I already had that loaded up. Okay, so just looking at a bullish bet, September regular way, stock was 56 bucks. I was looking at the 60-65 call spread combined with selling, I think it was the 50 puts that I had here. Let's see if I can, oops. Why is that not working? Yeah, I had the 50 puts in there. It's possible that the problem we're getting is that there was no bid. We were able to put this trade on using the 50 puts for a 35-cent credit when I was looking at this before the close. We're going to take a look at the Bloomberg prices and see what that looks like there. But mid-market, it looked like you could get a credit for selling the 50 puts and then buying the 60-65 call spread. Small credit, but a credit nevertheless. And downside in that case would be that you put the stock at 50. Let's just assume you got it on for even. So that is more than a 10% discount even from where we are right now. So where does that put us? You would effectively get net long the stock at something in the neighborhood of 11.5 times the bottom end of the full fiscal year 2025 EPS. And I think that's kind of interesting, right? And you would still have about 10% potential upside and a nice buffer as well. So we often try to take a look at trades before you get, before a catalyst such as earnings. This is a situation where sometimes the best trades you're going to find take place once that information comes out. We're coming off of a disappointing earnings. the stock was cheap, but certainly not as cheap as it is now, net of a substantial decline today. I mean, 30%. These are the kinds of moves that actually change what you're looking at in terms of the valuation. So trade idea there, one that I think is kind of interesting. I haven't put this on myself yet, but it was something that I was looking at. I doubt he's watching, but one of the things that got my eyeballs on this in the first place was my good friend and former boss from Ivory Capital from many, many years ago, 20 years ago, more than 20 years ago, I think, at this point. He was the one that was taking a look at it, and I believe he may have taken a flyer on the long side. And this isn't typically the kind of space where he traffics, right? He likes to look for growth at a reasonable price. Growth that exceeds S&P growth, growth that exceeds GDP growth, all that kind of stuff that I often talk about. But this did come on the radar, and I think it's interesting. So that's the first one. Second one to take a look at. So that was the worst performing stock in the S&P 500 today. Worst performing sector, as I'm sure all who are watching will know, was technology. But the second worst performing stock was also earnings related, and that was, of course, Tesla. So this is a slightly different circumstance from my point of view. Everybody watching will probably know that I am a big fan of Tesla. I'm a big fan of their products. I'm a big fan of Elon Musk. If you can carve out some time, I think it's worth watching the conversation that Jordan Peterson had on his podcast with Elon Musk. It was a 2-hour-long conversation. Interesting conversation, and I think it shed some light on Elon's views of this election, which also deserves a little bit of attention, but we'll get to that in a second. That said, all of these things being positives, I don't think that now is the time to dip one's toe into the water in Tesla if you don't already have a position there. I don't think that all of this damage is done. There's two real reasons for this. The first reason for this is that it doesn't feel like the washout for the high-flying stocks is necessarily over after a couple of bad days. We've had a couple of bad days, but I don't think it's over yet. And I would rather see this, if there is a rotation out of those, and also potentially a broader market pullback. It's hard for there to be a rotation without a broader market pullback. The broadening would have to be so extraordinary because the big names, whether we are talking about Amazon, NVDA, Tesla, all of these, their weights in the indices, in the NASDAQ 100 and in the S&P 500 are so substantial that essentially all of that capital has to flow into a much broader array of businesses to essentially support the index just because of the index weightings. If money is flowing out of those names, the indices are going to go lower. And as the indices go lower, it could encourage people to pull money out of those higher flying names. And I think it's wiser to wait until we start to see some measure of stability before we dip our toe in the water. And the fact is that in Tesla's case, it's not as if this company is extraordinarily cheap. It is much cheaper. Let's look at it on price to sales basis as well. I don't know that price to sales is the metric that makes the most sense when we think about it, but we were looking at it just a second ago, so we will here too. And one of the things we can see is that unlike in that Lamb Weston case, it isn't as if that as a multiple is, at a 10-year low. We're still well above that. And actually, we should just look at a legacy automaker as well. I have seen, a number of folks come out and say, oh, we should be taking a look at Ford here. Many seem to think that their doldrums could be over, and they sell, of course, the best-selling vehicle, the F-150. I think they're doing a revamp on some other products. One quick point I would say is that dealer inventories do seem to be growing a little bit. We have seen some buildup in inventory in the Stellantis group products, so that would include Jeep vehicles and Ram trucks. Ram trucks are not, their market share is considerably smaller than Ford and GM's is in the light-duty truck segment, and I'll include in that, so I'm talking about half-ton, three-quarter-ton, one-ton trucks, which are very high-margin products, by the way. So when we think about the profitability of these companies, these are the things that we want to look at. Sales of F-150, 250, 350s. This would be the 1500, 2500, and 3500 series trucks for General Motors and the Stellantis Group's Ram trucks. And then, of course, the sales for their larger SUVs. So we're talking now about, in particular, things like the Jeep Wagoneer and Grand Wagoneer, Chevy Suburbans, Tahoes, things like that, Cadillac Escalades, and then the Ford Expedition. Lincoln has really not been doing so fantastically well lately. I don't know that that's necessarily deserved based on a quality of product basis, but it is what it is. The buildup in inventories means that the margins on these products is not going to be what it was, because we are starting to see, and I think we've highlighted this on earlier live streams, an increase in the number of incentives that are being offered on these things. Okay, so now this kind of flows into another, a continuation of the conversation that I was having on Monday as well, which is the election. Presumptive nominee Kamala Harris, it would seem, over the 2 days since the last live stream, is gaining meaningful traction. It seems like the Democrats have rallied behind her, and the polling numbers actually, several polls have her leading, which is interesting because at one point when they were doing head-to-head polls, she was one of the few people that seemed to be polling worse than Biden, which was one of the concerns I think that Democrats had about having her replace him at the top of the ticket. But I think her taking over as the presumptive nominee has invigorated the Democrats quite considerably. It seems to have engaged a younger sort of demographic, and she's at the moment polling well. And so I think the assumption that Trump was favored to win has been diminished somewhat. There is still a considerable amount of time left. There hasn't been a big policy debate, so let's just talk a little bit about policy. She has, at times in the past, proposed policies that there's simply no way to think that this is going to be better from an economic point of view and therefore supportive of equities. She has, for example, at one point said, and she's gone both ways on this, but said things like we should ban private health insurance. She was on board with Bernie Sanders when he was suggesting that. A proponent of single payer, which is, of course, high on the agenda for the further left, more progressive part of the Democrat platform. And so that would not necessarily be a positive. And she has historically favored more of an open borders policy and some of the other things that are not particularly popular. And she has encouraged plenty of policy proposals and spending proposals, which I think we can generally agree would be considered to be inflationary. And none of those things are particularly positive for equities. And I bring this up because obviously Tesla's earnings were disappointing. Lamb Weston's earnings, while disappointing, really didn't have much impact on the S&P overall, even though it was the worst performing stock. And it's just simply not a big enough constituent of the index. I mean, it was, like I said, $12 billion enterprise value. I think it's about an $8 billion market cap at this point. It's not going to swing the index around that much. However, if people are flowing out of equities more generally, this is the kind of price action one would expect to see. And so I think that, as we've previously discussed, if Trump starts to poll better, that's going to be more favorable for equities, and it might be more favorable for some smaller cap. We were talking a little bit about that sort of Trump trade, if you will. As her polling numbers go up, that Trump trade is going to essentially come undone. And, you know, I didn't necessarily I had a feeling that maybe she would poll better than people had expected, and we definitely expected a narrative to emerge in support of her by Democrats, and we have seen that. But I think this is just an important thing to remember, that we are going to see some price action, price volatility that correlates to, you know, the relative performance of these respective candidates to one another, and we definitely have seen that over the course of the last couple trading days. Okay, so with that, I am going to just see if we have any questions, and perhaps we can look to address some of those. Okay. Let me start with this. PC is asking sectors that do well before the impending first rate cut, and what between the first and the second. Okay. I think an assumption that one could make on a rate cut, a potential benefit would go to financials, right? Because as a steepening yield curve is good, all else equal, for generally for financials from an operating perspective. Okay, so let's just make sure we're fairly clear about that. As I've previously highlighted, if you just take a look at the money center banks, for example, they are not all affected completely the same by these dynamics, and part of the reason for that is that they all don't carry the same amount of duration on their book. JP Morgan appears to have managed the duration in their portfolio very, very well. Bank of America did not. How that impacts the banks, and you can see this in their performance, is that even though the held to maturity book isn't marked to market, investors can still do that calculus, right? So what we know is that if the long end of, you know, if we start seeing 10-year rates go up a lot, while it's true that for new lending, all the banks are going to benefit because they borrow short, lend long, and so the steepening of the curve should improve net interest margins at the very least. If the long end of the curve goes up and they're carrying duration, then their held to maturity book, if that's the part of it that we're going to look at, the value of those assets is going to decline. And those assets, you know, the nice thing is, of course, that you're able to post those at the Fed, and if the short end of the curve is coming down, then you don't get into that negative carry situation that I think we discussed. It was probably a couple months ago now. But basically, it's all fine that they can post these assets essentially at par as collateral at the Fed for funding issues, but that's not that great if and as short-term rates are very high, because if you're getting paid very low rates on that book and you're posting them as collateral to borrow at a higher rate, it's not a great trade, right? So you don't want to get into that negative carry trade. So the JP Morgans of the world are going to be better positioned if the curve steepens. So that's definitely a positive. And you know, so there's another part. It's not just rates. If the rates come down, that could be good for equities. If rates come down and it is good for equities, that would be good for companies like Morgan Stanley on the asset management side. But remember that their fees are tied to the value of all of those assets under management, because they're principally on the asset management side of the business now. And so I think that's another one that you could potentially take a look at. All right, so Google Call Calendar, interesting. All right, so yeah, this is, yeah. I'm out here but watching on YouTube TV, not easy to ask questions, so says Red State Run. Okay. Yeah, sorry for that. You know, we should probably, I don't know how one does it. It would be great if we could actually take calls. I don't know how we can do that, but it would be interesting fun, I think, to be able to do it. Okay, so Alphabet Call Calendar. Yeah, this was not great in terms of the earnings results there. So let's just take a quick peek at Google's price action today. Well, let's just take a look at it over the course of time. So this was one of those names that this is you know, a longer term chart, 1 year chart that we're looking at here. If we just back this, we'll just take a look at the last 6 months here. By default, I've set this candle chart up to include the 150-day moving average. This is a name I generally like, I would say. And if I can highlight this moving average line, which I seem to be struggling to do. But, you know, this was not, look, their earnings numbers were not particularly well received. Let's be honest about that. I think part of this also was that the entire AI trade was coming a little bit unglued today. And look, you know, investors can be fickle about such things. You've got companies making big investments in new technology. You can remember how much damage was done to Meta when they were making considerable investments in the metaverse. And that actually became, you know, one of the best trades ever, because it's important to remember that all of these businesses, names like Alphabet, names like Meta, these are businesses that have the capability to, you know, pivot their investments. So if they decide to reduce the investments that they're making, you know, they can bring their profitability and cash flow numbers back up very, very quickly. This company is, you know, not unreasonably priced. I think it is safe to say it's actually, I think, trading at a discount to the broad market at this point. And this, with full year 2025 estimates even now coming in at about 15+% year-on-year top line growth and maybe 13% bottom line growth, which would be, you know, as I've said before, you know, what do we expect the S&P on average in the post-World War II era? The S&P has seen about 6 to 7% year-on-year earnings growth. And because it's always going to be an amalgam of the best businesses in, you know, publicly traded businesses in the United States, and generally therefore the world, because our biggest multinationals are, you know, for the most part the biggest and best in the world. So, you know, double GDP growth, and this is doing double what that is, right? That said, as we've talked about, there's a little bit of rotation. This is a different story though, because it's not trading at a huge multiple. So I still kind of like that calendar. I might want to consider a reset on the longer dated strike, bringing that down. Just, you know, you could probably bring this down a bit, because once you get something like this coming out, let's actually do this. Let's see if I can, I want to show, I'm going to expand this a little bit. Let's just take a look at some of these price gaps. Okay, so can I want to bring the, if I can, where am I? Usually I have a mechanism by which I can bring up, I'll have to do it this way. Maybe if I do the GPC. Here we go. Okay, so what I'm going to do right now is I'm going to put flags in here. And these flags are generally going to correspond. This is 5 years worth, so this is 20 earnings. You know, what you're going to be looking at is their earnings results. And one of the things you can see is that this is when you get those big moves right around earnings, and then you get things to flatten out a little bit, and then whatever that trend is tends to have some follow through. So my guess is that you're not going to get a huge amount of upside price action in the name between now and their next earnings, which is going to be taking place right now. The expectation, bear in mind that this is just an estimate, so always as earnings approach, you can go to verify this. Right now, October 24th, and we could actually take a look at the calendar and see whether that makes some sense. But yeah, I mean, I still like the call calendar. One other quick thing to think about in these calendar trades. Take a quick peek at the term structure too, because once the event comes out, what do you get? Very often you get a vol crush. We did get a vol crush, but look at this. All right, so there's still, yeah, so November captures this, but right now, so this is October that does not capture the next event. And we can see, though, that some of this near-dated stuff is still trading over that. Probably just some built-in volatility expectations for 2 to 3 day follow-through on today's downward price gap. But yeah, I still do like calendars in Alphabet to the long side. Do like the company. Not a huge quarter, obviously, but. Okay, so what do we have here? Thoughts on Disney stock is hurting, but sitting on a load of assets, just not being utilized properly. Thanks. Okay. So Disney's kind of an interesting case. One of the things that I'm sure some of you may have seen was that credit card delinquencies have hit the highest levels. I want to say it's in more than a decade. I'm trying to remember exactly what the story was. I think it might be something like 12 years. I was looking at this earlier, and it was either 2011 or 2012, I think was the last time we saw credit card delinquencies at this level or higher. And obviously that's going to have some bit of an impact on discretionary spending. The parks have been doing very well. Let's just take a look at what's going on with Disney here. A big portion of their business, a big portion of their value, and they're arguably the crown jewel of their assets in terms of operating performance was for the longest time because they owned ABC, they owned ESPN, was ESPN. That is less certain now. But let's just take a look at how their income statement is showing some of these things breaking down by segment. I think they have it here. All right, where we go. See what we're doing here. Actually, I think pull up the segments here. So yeah, this is what we're looking at. So this is the entertainment side and the experiences side, which is going to include their theme parks and things like that. We can sort of get a sense of what their year-on-year growth has been, and quite positive. We can see that between 2022. Now, this is not entirely representative, of course, because there was, number one, there was a lot of pent-up demand, and also because, in the pandemic period, a lot of these numbers were kind of artificially depressed, significantly artificially depressed, and completely depressed in some instances. So a little bit hard to get a really good read on that. That said, why don't we just take a look at where the company is in terms of their multiples, and one of the things we can see is that it is at the lower end of the 2-year range at least. Is the 2-year range the number to look at? Well, it gets distorted for the reasons I was just talking about. So you can imagine that as we saw a lot of those businesses essentially get shut down or partially suspended. Obviously, the cruise ships weren't running for a period of time during the pandemic. The theme parks were, significantly impacted. You can't really take a look at the multiples in the same way because, of course, investors were anticipating that. So what ends up happening is that if you're looking at it just on a multiple basis, people are expecting it to come out on the far side at some point. And so it's going to trade at a multiple that's going to be distorted because of that. So here too, I think it might make some sense for us to take a look at, why don't we just take a look at price to sales before the pandemic and how it is now. And we're going to try to exclude that period in the middle from our, calculations, because I don't think that's, that can really throw things. So it's important to do that in cases like this where you have significantly anomalous events. So I'm just going to get rid of the earnings because, of course, that all got thrown off as well. And so, again, this is kind of a similar way to look at it. Here's the revenue picture. Revenue picture has been good. Obviously, this was all completely thrown off in the middle here. So we're just going to take a look at the price to sales. And what we can see is that on a price to sales basis, it is trading quite cheaply. Part of the reason for that, though, is that remember that ESPN was the most significant asset within their entertainment side and the one with the most consistent margins, and that is the one that I think is, we can't attach the same multiple to it that we once were able to. And so I think it's probably attractive here, simply because that has been discounted pretty significantly. But just bear that in mind when you look at all of these things. Just try to give those some thought. So let's bring up. Let me see if I can find another question here. Monday AMQB, bearish on Tesla and highly skeptical on the October announcement about full self-driving. Too early, look at a bearish bet. I also drive one. Oh, good. Well, yeah, I think, look, this is a very fair thing, right? It is fair to say that we think that they build a great product, arguably the best for the money. That's kind of where I'm at. I think they are going to win the race in the full self-driving. I think they are going to win the race with respect to robo-taxis, maybe not on the timeline or calendar that Elon forecasts, but that does not mean that I think that all the damage is done yet on the stock. So let's just frame up a bearish bet if one's so inclined very quickly on Tesla. So one of the things that's going to happen, I probably had OptionPlay up in another window, and did I have it over here? No, maybe I didn't. Okay. After earnings comes out, we saw in Lamb Weston's case that implied volatility is higher. There's a bit of leverage on that balance sheet, and I was looking at 2 to 3 month vol, which is one of the reasons I like that call spread risk reversal as a way to potentially dip your toe in the water. In some cases, though, what you're going to see is that you're going to get a little bit of a vol crush. In the short dated stuff, I kind of expect that that's what it looks like here for Tesla. Why don't we just double check and see? We'll take a look at the term structure. And yeah, we can see it came down, well, it came down some, but it's still quite elevated. But there's going to be some anticipated follow through. So here again, we're getting a pattern very similar to the one that we saw before. I think a good way to try to press on the bearish side in Tesla, if you are so inclined to do that, would just be a very simple vertical put spread. We are going to see a little bit more vol come out of it. You can try to capture that next event if you choose, but I tend to like to keep verticals a little bit shorter. And that's on both the long and the short side. And the reason for this is that they're just not going to go to their max value or their min value very quickly. So yeah, we have that. And let's see here. Okay, let me just quickly pull up some other questions that are here. Corey Henderson asks, if I have a covered call out of the money approaching expiration and want to close or roll it prior to expiration, best day to do that would be the last day of expiration or a few days before. It's for NVDA, which is liquid. Okay, very good question. To me, that's going to depend a little bit on how much extrinsic premium is involved. In many cases, you're going to have a very minimal amount of extrinsic premium. And in that case, you might as well just go ahead and cover it. That said, if it's close to at the money, you want to push it as close to expiration as you can. Why is that? It's because the extrinsic value of an option's decay accelerates as a percentage of its own value as expiration approaches. So if we were looking at a chart of the decay of an option, you're going to see that its decay rate goes up and up and up and up as expiration approaches. It then will proceed to fall off a cliff, and that's only because there's no extrinsic value left. So in general, if it's close to at the money, there will still be some meaningful extrinsic value and therefore a meaningful amount of decay to capture as expiration approaches. So the short version is, yes, push it to the end. The only thing I don't like about that, though, and I will sometimes try to wrap things up a day or two prior, is because what happens if you're not going to be able to log on and resolve it. So just something to think about there. On my questions on rate cuts, could you tell me from empirical data? So PC, good question. I will actually endeavor to get some data together that we can show visually for the next one. So I need to make a note of that. Producer Jay, if you could make a note of that. We need to get some empirical data to show these relationships, because I think that'll make it a lot more interesting. Good day from James Foreman. Good day. I bought the August 30 VXX 14 strike for 30 cents. Should I sell this week or hold for another week or so? So there's going to be some decay that comes out of those things. I like to use these as a trading vehicle, generally speaking. So what's interesting here, because we've actually spoken about some hedging techniques for IWM. I think we talked about the triple Qs and SPY. If you have hedges on in those areas, and now that we've had a fairly sharp pullback today in particular, two things you could consider doing. One is spreading, so that would be selling a lower strike put against the ones that you already own. That would be a way to at least lock in some of what's already happened, or roll it, or both. And I think, but I don't think just staying here, especially if you had, say, for example, a 30, 35, 40 delta puts now in the money, especially if it gets up to that 60 delta, kind of a threshold where you might want to think about taking a look. Philippe Van Doren says, WBD, Warner Brothers Discovery looks more interesting to me. Paid $5.2 billion of debt back in 2023. Well, the company's got a heck of a lot of debt, so I think that scratches the surface. I'm just going by memory, but it was about $50 billion. I ended up with a little Warner Brothers Discovery when it was paid out as a dividend stub on an AT&T position I held at the time. What an enormous disappointment that was. I just don't like the way these guys are operating. And it is certainly getting cheaper, yeah, as you point out. So we're now down to about $42.5 billion, I'm sorry, $42.5 billion worth of debt. I just don't like to own companies that are shrinking in real terms. So that means inflation and GDP adjusted. And in this case, it's actually shrinking nominally. So if I'm looking at year-on-year revenue growth for Warner Brothers Discovery, forecast for the full year to be down, about 1%. So we're talking about maybe $400 million of lower revenues. But adjusting for inflation and GDP growth, this is negative growth of about 5% year-on-year. Not the kind of company I like to own. And, I just favor being long stocks on balance. I'm not a big short seller. I think hedging is fine, but you're not going to see me talking about short bets too often. I do from time to time, play around in it. But Warner Brothers, the company's not going to make money this year. And all of these businesses, they're always seemingly struggling, and there's these ideas that they're going to turn things around, consolidate. I don't know. I'm not a huge fan of it. It's cheap, It's cheap relative to its own history, I suppose. We could say that. But I don't know. That's kind of like, isn't that what Charlie Munger referred to as the cigar butt strategy? Something he used to criticize Warren Buffett for in their earliest days, which was, going and just looking around for the cheapest companies you could find and see what last couple of tokes you could get out of the thing. There's enough growing businesses. Why not stick with that? Yeah, Easy Mike points out, NBA just entered a deal with Amazon. Amazon is a growing business. Netflix, that's the other thing, is that these companies that you're talking about, you're looking at companies like Netflix, 30 times and growing. These are things that I think you can actually still consider owning, because I'd much rather own something that's growing at well faster than S&P growth rates and trading at a marginal, a 40% premium that you're going to pay for more than double the growth rate. Stick to the better businesses that are growing. That's just my approach, do what you will. Okay, so I think I have now chewed up the better part of an hour with all of you, about 50 minutes. Very much appreciate your time. As always, we're going to be doing another one of these, and we're going to talk a little bit about the relationship on rates and financials and things like that. And we'll try to pull together, if we can, a couple interesting graphics that we can incorporate for your use. As always, thanks for watching.